Okay, welcome. My name is Kyle, and this is going to be an e-tutorial on how to solve problem S17-6 from the Pearson workbook. So what we have here, Apple Distillery accountants have assembled the following data for the year ended June 30th, 2020. So we have financial data here. And what we need to do is prepare the operating activities section of Apple Distillery's cash flow statement for the year ended June 30th, 2020. And they use the indirect method for operating cash flows. Whoops, didn't mean to put that there, meant to highlight it. So we're going to be using the indirect method of the operating activities section of the cash flow statement. So we should know that the cash flow statement is divided into three sections. The first section is operating activities. The second section is investing. And the third section is financing. So with this statement, all we really need to do is prepare the operating activities section. So we're doing a partial cash flow statement. We're only doing the first section. Now, this is just not done, never in practice would this be done. We're just learning how to do the cash flow statement now. So typically an organization would prepare all three sections of the cash flow statement when they're doing it. But since we're first learning it, we're just going to do it section by section. And we're going to just do the operating section first. So I'm going to erase these right now. We're not going to be preparing the sections of investing or financing for Apple Distillery right now. We're only going to be doing the operating section. Now, they use the indirect method for calculating operating cash flows. The end result will be the same. It's just the steps are going to be different. In order to do the steps, what we do is we start with net income. And then what we do is we make adjustments to the non-cash items included within net income. Non-cash items in NI for net income. And then 3, what we do is we incorporate the changes in working capital items. So what are the changes in working capital items? Now, if we remember what working capital is, it's current assets minus current liabilities. That means we need to take into effect the changes in current assets and the changes in current liabilities. Now I have a delta here. Delta means change. So the change in current assets and the change in current liabilities. And that's really the third step. This can be thought of as 4 steps in total, with really between what is 3A and 3B. So I'm going to start here. As I know, all financial statements start with the title line, and we do 3 title lines. That's common convention. It starts with the organization's name, then the financial statement name, and then the date. So this is Apple Distillery Incorporated. This is the statement of cash flows, and it's for the period ended June 30th, 2020. Organizations can have a year-end date of whenever they want. A lot of organizations have a December 31st year-end. This organization, they've selected a June 30th year-end, so there's nothing wrong with that. And what we do here is we're just going to follow systematically the steps I've laid out to the right, with step 1 first. What is net income? Whoops, didn't want to highlight that. I wanted to draw an arrow. We're going to start out just by figuring out what net income is. We would get that from, of course, the income statement. So what I'm going to do here is look through what our financial data is and find net income. And it tells us here net income is $100,000. So it's going to be the very first line of the cash flow from operating activities. I'm going to bold this because it's a subheading. And in my title line, I have the statement of cash flows. Probably what I should have done is said partial, because it's not the complete statement. We're not doing the investing and financing activities section. We're just doing the operating activities section. So the cash flow from operating activities, what we're going to do is we're going to start with net income. And it was $100,000. And just format my numbers here so that they're a little bit better to look at. 100,000. So simple enough. That's step one. And didn't want to highlight that, so my apologies. I wanted to put a nice big check mark next to it. So hang on, maybe I'll just cross it out. Okay, then what we do is we go through the income statement and we add or subtract the non-cash line items on the income statement to net income, right? Because the income statement includes non-cash items. A common example is amortization. It's a non-cash transaction. Since that amortization lowers net income, we need to add it back if we want to figure out the cash that's generated through operating activities. So I'm going to go through just all of these line items here and pick, well, which ones are line items that would be included on the income statement, and specifically which ones are going to be non-cash. So I haven't read this question in advance. I don't know what's coming, so bear with me. I can see right away though, maybe what I'll do is I'll cross off net income. We're done with that. We don't need it again. But I can see right away that there's amortization expense at the bottom. It's a non-cash transaction on the income statement. Payment of dividends isn't on the income statement. Cash receipt for common shares, that's not on the income statement. Increase in current assets, no. Repurchase of shares, no, that's a financing activity. Purchase of equipment, payment of note payable. Okay, so really there's just one non-cash income statement line item here, and it's amortization. So I need to add back amortization expense. And it was 40,000. And I'm now done with this line item, amortization. So I'll just cross it off because I know we're not going to need it again. So now I'm done with step two, adjustments to non-cash items that were included in net income. Step three is, what are the changes in working capital? So working capital is, of course, current assets and current liabilities. So I'm going to go through the balance sheet now and figure out what happened to all of our current assets and current liabilities. Did they increase or decrease? So to do that, of course, if this was the real world, I would go to the actual balance sheet and look. I would need 2 years worth. This problem, though, it just gives us descriptions of what happened. So I have here payment of dividends. Well, I'm only doing the operating section of the cash flow statement. Payment of dividends would be out of financing, so it's not going to be included in this problem. Similarly, cash receipts from the issuance of common shares. Issuing common shares, again, is a financing activity, so it's not going to be included in the operating activities section. But increase in current assets other than cash. I'm going to need to do this. Why? Because current assets are a part of working capital, so I need to incorporate the changes. Current assets went up. So let's think about this here. And I'm going to do this through an example. So let's say accounts receivable goes down. What's the impact to cash of accounts receivable going down? Well, that means that we collected cash from customers, so cash goes up, right? So it stands to reason that when accounts receivable goes up, thinking about accounts receivable, that cash goes down, because it's the exact opposite of what happened just above. And that's true. And a lot of people struggle with why. Why does it, when accounts receivable goes up, why does cash go down? Well, let's just think about this intuitively right now. So we just, in step 2 here, we made adjustments to non-cash items that were included within net income. Those were specific line items on the income statement that were non-cash that were included in net income. Now think about here for a minute, just bear with me. Let's say an organization makes a sale on account. The journal entry for that would be to debit accounts receivable and to credit sales revenue. So this journal entry here increases accounts receivable, which is a current asset, and it increases revenue. And we know when we increase revenue, that's going to have a positive impact to net income. So since this is a non-cash transaction that impacted net income, we need to make an adjustment for it. It just didn't impact net income directly on the income statement. Yes, there was revenue for it, but we didn't know it was accounts receivable related until we looked at the changes from year to year of accounts receivable. So we do in step 2 adjustments for non-cash items included in net income. That's on the income statement. And then in step 3, we're basically just doing the same thing. We're just looking at the balance sheet now to figure out which transactions are going to impact net income. And accounts receivable, when it goes up, we know that the journal entry is going to look like this. But since we didn't collect on this, it's going to be a decrease to cash on the cash flow statement. We need to make an adjustment to decrease it. So that's a little bit of background about why. Now looking at this problem, and I don't think I'm going to need all the space down there, so I'm just not going to bother erasing it to save time. There was an increase to cash of $60,000. So what I'm going to do is increase to current assets other than cash. Oops. And remember, that's going to be a decrease to cash. And now we've done with that. Repurchase of Apple Distillery shares. Now remember, issuing and purchasing shares is a financing activity, so it's not going to be included within the operating activity section. Purchase of equipment next is a investing activity, so it's not going to be included here. But then we have this decrease in current liabilities. So let me just explain this a little bit down here. So maybe I will need the space. So I'm going to erase this. Bear with me here. And what was it? A decrease in current liabilities? Yeah, decrease in current liabilities. So accounts payable is a common current liability. When accounts payable goes down, as in this problem, that means they're paying their suppliers. So cash is going down. And that's exactly what's happening here. I can't say for sure because it doesn't tell me accounts payable is going down. What it's doing is it's grouping all of the current liabilities together. But I can kind of infer that they're just paying down their bills. So I'm going to have decrease to current liabilities. That was how much? $10,000? Yeah, $10,000. Okay. And I'm done with this decrease in current liabilities. And then we only have 2 line items that are left: payment of note payable and cash receipt of sale of land. So I would need, remember, we're only doing an operating activities section. It tells me explicitly what my current liabilities are. So I can kind of infer that this isn't a current portion of the note payable. And also note payable would typically be through like a financing activity. So it wouldn't be included within the operating activity section. And whenever you buy or sell land or property, plant, or equipment or long-term asset, that's an investing related activity. So I'm going to cross those 2 out. So there was really only 2 line items that we needed here within this problem specifically. So then I've done it in its entirety, so I can just put a total here I'll put an underline, and then I can say net cash provided by operating activities. And cash flow increased from operating activities, which is a positive sign for this organization. So I hope that you found this e-tutorial useful. If you have any questions, please feel free to reach out to me or to any of your instructors, and I'm happy to help. We're happy to be here for you. Otherwise, this was an e-tutorial for S17-6 from the Pearson workbook. My name is Kyle, and have a great day.